I find it interesting the sort of title of your report today, if you want to call it that, is the tone-deaf Fed, in part because there is a question as to whether the allegedly data-dependent Fed is really data-dependent at all, or if they've already made up their mind and set their destination and come hell or high water, they're going there no matter what.
I think it's the latter, Scott. I think that if you look at the statement in the minutes this week on last Wednesday, where they said no Fed official is forecasting a cut for 2023. I mean, that may be true, but how do they know that? How can they be so sure? Look at the SEP itself, the statement, the summary of economic projections. 17 of 19 officials over 5%. Mm-hmm. And then look at what they said last week. Despite the wage data coming in weaker, and most importantly, the ISM services data coming in showing contraction in that sector, no change in the rhetoric. I think they are in a forward guidance mode, a mode in which, Scott, they are going hell or high water to that 5% mark. They have a date with 5% rather than being data dependent en route to 5%.
Maybe we just should stop listening to what they say and pay more attention to what they do in the meetings ahead. That when a Bostic or whoever, Esther George last week, come out and, respectively suggest, well, we're going to go above 5%, we're going to go 5.4 and hold it there for a while. I mean, okay, so what? That's what they say now. Why should we take them at their word?
Because it's the best gauge I think you have of what they're going to do.
Their word?
Yeah, I think that's all. That's what you have. I mean, I don't know. Do you have another thing to do, or rather than what are you going to look at otherwise?
But
Scott?
when we say, see, the problem with that is what some have already said is that, well, you can't take them at their word for this because they were wrong before. So let's just see what, in fact, they do. They got the transitory thing so terribly wrong.
That's right, and I think that's the issue right now is that they're heading. It seems to me the same kind of sort of monolithic. Everybody on one side of the boat idea that they decided it was transitory. I'm just surprised they, A, haven't softened their rhetoric given the data, and B, that there isn't a broad range of opinions, it appears, on the FOMC. You look at what the market did, Scott. Look at the 2-year note from Friday. And those two steps down. One person talked about the wages earlier on your show. The other step down, if you look at that 2-year note from Friday, is that what happened with ISM. The market took that pretty hard in their sense of what the outlook is for the economy. We had inflation expectations come down. There's that two-step process there. You can see that shelf there in the middle on the way down. What does that look like? Is that kind of an Everest kind of thing? I don't know what if you guys have done any climbing or anything like that. And then it's actually trending down 420 again today, Scott. So the data has been weaker. The market is taking it that way. If you look at the spread of the market and the pricing for the probabilities in May, there's a number of opinions out there. There's not among the 19 members of the FOMC.
I mean, you say, I don't know why they haven't changed their language a bit, but in reality, we know. The reason they haven't done it is because if they know that if the moment they do, the very stock market and the market in general, the stocks for certain would take off immediately, and they can't afford to have financial conditions loosen any more than perhaps they already have and are, because that's what the immediate impact would be.
I think that's probably right, Scott. I do think, though, that the market is already doing what it's going to do or has already loosened financial conditions in that regard. And if they want to do some damage, I guess, to the long end of the curve, they could sell bonds out that way. But I think the problem for me, Scott, is that they do not appear to be incorporating the considerable risk of recession. And what is not talked about enough is the effect of balance sheet reduction. They're going to do $1 trillion this year. They did $400 billion last year. I had a conversation with Bullard during a scrum with reporters last week, and I asked him whether or not his formulas. Remember that he has that range of 5 to 7%. I said, does that range of what the appropriate rate of the funds rate is incorporate balance sheet reduction? He said no, and I said, does that mean you're being over sufficiently restrictive? And he said some could argue that.